Welcome to the Personal Finance Workshop created by the Farm Credit Associations of North Carolina. I am Amanda Smith, a credit analyst with Farm Credit in Greenville, North Carolina. I look forward to sharing valuable information with you to help as you plan your finances for today and prepare for tomorrow. Let's get started. Sorry about that. All right. So far, we've discussed saving and spending money. Now we'll look at borrowing money when you don't have enough cash on hand to cover an expense. This will involve credit and loans. A credit report shows how much debt you have and if you have paid off your bills on time. It shows all credit accounts you have, including home mortgages, credit cards, equipment dealer loans, student loans, etc. It also lists if you've been late on any payments, if you have went through any bankruptcies, if you haven't paid your federal or state taxes, and if you have any judgments. The report also lists your credit score. A credit score is a calculated number that shows lenders how likely you are to repay your debts. It represents your reputation as a borrower of money. Your credit score is something you will have if you ever borrow money. It will be used anytime you get a loan to purchase a car, to take out a loan to pay for college, buy a house, even buy things like ATVs and campers, if you buy any land, and if you get a credit card. Your credit score is calculated by 3 credit reporting agencies: Equifax, Experian, and TransUnion. These are all averaged out and come together for your final FICO score. FICO is the score that people look at most often to get the best idea about your credit history. You are allowed one free credit report from each of those credit reporting agencies once every 12 months. It is important to occasionally check your credit score to make sure that there are no fraudulent charges and that your identity has not been stolen. It is also important to maintain a good credit score. A credit score can range from 300 to 850, and you want your score to be as high as possible. Typically, a good score is above 700. A score above 800 is exceptional, and not many people will get a score that high. So, what affects your credit score? Many things can affect your credit score, such as your payment history, which accounts for 35% of your score. This shows how well and timely you pay off your balances on credit cards and any other debts you have that need to be paid. So, for example, I personally have a mortgage and a student loan and a couple other debts that have monthly payments. I set them up on auto draft, so the first of every month, it automatically drafts that payment out of my account so I know that I'll never be late. Because as you can see, payment history makes up the most of your credit score. So it's very important that you always pay those debts on time, that I always highly recommend to people to set up auto draft. Outstanding credit versus limit is 30% of your score. This shows how much you're allowed to use compared to how much you actually use. Normally, you want to keep this around 10% for each credit card. If you go above this and leave the balance high on it month to month, it can hurt your score. Excuse me. So, for example, if you have a credit score with a limit of $1,000, that is the most you can draw on that credit card at any one time. You should aim to never have more than $100 at a time drawn. Keep it 10% or less. Length of relationship is 15% of your score and shows how long you have had credit. The longer you have had a good history, the more it can help your score. It shows that over time, you have consistently paid off your debt, and that will make your score higher. So I always recommend to people when you first get to college or even when you're in high school, if your parents or another trusted adult can add you as an authorized user on their credit card, it will help you because if you start using that credit card, you'll be building up your credit history so that by the time you need to buy a car or buy a house, you already have a good score as long as you make sure you pay it off monthly. All right, the next is types of credit. And types of credit is 10% of your score. This talks about what kind of credit you are using. This means having a diversity of credit types, like a car loan, a credit card, a student loan, and a mortgage. Showing that you can pay off a wide variety of loans can really help boost your score. New credit finishes the score off at the last 10%. And this shows how many new credit accounts you have opened in the last 12 months. This also takes into consideration each time someone is pulling your credit report. If it shows that your credit has been pulled a lot in the past year, it can indicate a greater risk. It can hurt your score to pull a credit report a lot and show that you're trying to get money from many different sources. And this might lead lenders to believe that you don't have enough cash on hand to pay for many different things that you're looking to buy, and that can carry some risk. There are a lot of benefits to having a good credit score, one being that it is easier to get accepted for a loan. With a high score, it shows lenders that you have been responsible with the money lent to you and that you have paid it back on time. Another big benefit that will save you a lot of money is you will be given lower interest rates on the loans that you receive. This will save you money in the long run by not having to pay a high interest rate. You will also be eligible for lower auto and homeowner insurance premiums. These are both generally expensive, but with a good credit score, you will be able to save thousands of dollars each year. It can also eliminate the requirement of paying a deposit when signing up for utilities like power. So if you enter into a rental agreement to get a rental rather than buy a house, or if you do buy a house, you will have to set up the utilities in your name, the electric bill. And if you don't have a good credit history, you will have to pay an upfront deposit. It's usually around $250. And personally, I know when I got my first apartment in my name, I didn't have a lot of money laying around. So it really helped me that I had gotten a credit card early in college, that I had a good credit history. So then I didn't have to give $200 as a deposit on my utilities. So that's another reason I really recommend getting started early on credit. In addition to your credit score, lenders often look at some top C's of credit, which include capacity, character, and collateral. So capacity asks, can you repay the money that is lent to you, and what income do you have? So a lender will look at how much money you make per month and then figure out how many debt payments you have, and then factor in other expenses such as food, gas, etc., and then figure out if you will have any money left over. So then they know if you can repay your debt to them. Character asks, have you been a good customer at other banks, and do you have good repayment history? This is where your credit score is really important for the timeliness of your payments. That is what will show a lender if you have good repayment history or not. Collateral is what can the lender hold to get you to repay your debt. They will take a lien on some sort of property, which is a statement of ownership rights on a piece of collateral. So for example, I just bought my first house a couple months ago. The bank took a lien on my house. And what that means is if I don't pay my mortgage on time and I get what we call delinquent on my mortgage, that I'm not paying it, the bank can legally take ownership of my house and then sell the house to pay off that loan. So collateral is very important. Now that we've covered credit and talked about the things listed on your credit report, you might be wondering what exactly a loan is. Loans are a form of debt incurred by an individual or entity referred to as a borrower. A borrower borrows a sum of money as an advancement, and in return repays the lender the advancement with additional charges, interest, fees, or other conditions applicable. Loans may be for a specific one-time amount or as an open-ended line of credit with a specific limit, such as a credit card. Loans occur when a sum of money or credit is borrowed from lending institutions, such as banks, credit unions, or farm credit, and is expected to be paid back usually with additional interest. Now let's go over some basic loan terminology commonly used when regarding loans. A borrower is a person or entity that attains finances from another individual or business for a specific amount of time with the condition to pay it back. So I'm going to take you through an example using this terminology. So I'll use the example of me since I just bought my house a couple months ago. So I am the borrower. I went to the bank and asked for a loan in my name to purchase a house. A lender is an individual, entity, or financial institution that makes money available to another person or business with the expectation of repayment. And repayment will include interest and fees. So in my example, my bank was the lender. Collateral is an asset a lender accepts as security for a loan. In the event that a loan cannot be repaid by a borrower, collateral is used as a form of payment, as well as an incentive for borrowers to repay their debts. So in my case, the collateral is my house. And I have a lot of motivation to pay my mortgage every month because I don't want to be kicked out of my house so that the bank can sell it and pay off the loan because my house is collateral. Interest is the charge or cost of borrowing money and is usually expressed by an annual percentage rate. The term APR refers to the rate of interest charged to borrowers and paid to lenders. So, in my example, the amount of money that I borrowed to purchase my house is what's called the principal amount. Then the bank makes money off of that loan by charging me interest, which is a percentage of my loan amount that I pay to them every month, which basically compensates them for giving me the money up front. And that is how banks make their money. Now we'll go through a couple other terms. Loan amount is just the amount of money that you spent to purchase whatever item you did. So for me, the purchase price of my house is what my loan amount ended up being. And the larger the loan amount, the larger your monthly payment will be in general. Now, the next example is a down payment. I ended up doing a special government program that I didn't have to put a down payment on my house, but that's not very common. Normally, you have to put cash up front to get a loan. So 5% on average for homes and 15 to 25% for land. So I'll give you a hypothetical example. Say that you want to buy a house for $100,000. That is the purchase price. If you had to do a 5% down payment, you would pay $5,000 directly to the seller, and then you would get a loan for $95,000 from the bank. So 95 and 5 together equals 100, which is your purchase price. But the bank only had to give you 95,000, 95%, and you put 5% down. For land, it would be the same thing. Say it's a 25% down payment and you're buying a $100,000 piece of land. You would give $25,000 directly to the seller and then finance 75% with the bank. Normally, why down payments exist is it's less risk for the lender, for the bank. So say I got that piece of land for $100,000. I put $25,000 towards it, finance $75,000, and then I lose my job the next month. When the bank goes to sell that piece of land, if I can't make the payment, then they have a better chance of getting enough money for it when they sell it to pay back the whole loan. Fees are charges in addition to the purchase price of the things that you buy. They cover costs that the lender has in providing money to you for your purchases. If you have ever heard the term closing costs, a lot of those are fees. So when I closed on my house, by the way, closing just means when you sign the papers for the loan. So when I closed on my house, I had what was called an origination fee, which was $1,000 that I paid to my bank. And that just covered the cost of the time that the administrative staff spent putting together my paperwork and helping me through the closing process. So fees are generally paid at the beginning of your loan, but not always. It can depend. And it's really important for you to make sure you understand that whenever you do sign up for a loan to know all of the fees involved. The next term is term, which is the length of time you have to repay the loan. The longer the term, the lower the monthly payment in general, but you end up paying more total interest over the life of the loan. So my home loan, which is called a mortgage, I apologize if I've used that term and you weren't familiar with it. A mortgage just means a loan to buy a house. So my mortgage is 30 years, which is 360 months. So I have a 360-month term. I make 360 monthly payments until it's paid off. Because it's a longer term, I split my purchase price into smaller amounts, so my monthly payment is lower. But I'm paying interest on the same money for a longer amount of time, that my total interest is much longer than if I had done a shorter. The interest rate is the percentage amount added onto each payment, and the higher rate leads to a greater total interest charge over the full life of the loan. And that makes sense. If you buy land for $100,000 and get a 3% interest rate, you'll end up paying less than someone who got a 5% interest rate. More about interest rates. Lenders offer a variety of fixed, variable, and adjustable rates depending on the type of loan that a customer has. A fixed interest rate is an interest rate that stays the same over the span of the loan and for a portion depending on your agreed arrangement. But in general, a fixed interest rate is the same for the life of the loan. So say that the interest rate on my mortgage is 3%. Every month, my interest rate does not change. It is 3% for all 360 months of my mortgage. Variable rate loans have an interest rate that can vary up or down during the term of a loan. The rate being charged on variable rate loans is tied with a particular index, and these indexes allow you, the borrower, to judge for yourself what potential movement there might be in the rate. Most credit cards are variable rate, which means that one month they might be 17%, they could creep up to 18% the next month because they move as the economy moves. So it's very important when you look at a credit card too to understand how much your rate can change each month if you're not paying it off every month. Adjustable rate mortgages are a special kind of product that combine features of both fixed and variable interest rate products. Adjustable rate mortgages fix the interest rate for a specific period of time, 1 year, 3 year, or 5 year. The interest rate is indexed to the U.S. Treasury securities. As U.S. Treasury rates move, the rate on the ARM may also move after an initial fixed period. So you will see this sometimes if you get a home mortgage, but adjustable rates are not as common as fixed and variable. When obtaining a loan, it is important to ask whether there is a prepayment penalty for the loan. A prepayment penalty is an additional fee that some lenders charge you for paying your loan off early. And the reason they do that is they want to make sure that you've paid them enough interest to compensate for the time and risk they took in giving you the loan. So very important, especially in a mortgage, to make sure you understand if there is a prepayment penalty that could be charged if you wanted to pay the loan off early. There are two different types of interest, simple and compound interest. So simple interest is just interest on the principal amount borrowed. So say that I borrow $100 and I have to pay it back in a year, and the interest rate is 5%. 5% of 100 is $5. So if I have to pay back $100 in 1 year, I'm paying them the $100 plus $5 in interest. So I'm paying them a total of $105 in interest a year from today. Compound interest is interest on the principal and the interest accrued on the amount borrowed. So think through that same example. Say that compound interest is involved. So my first year is still the same. $100, if I'm supposed to pay it back in a year, 5% interest, it would be $105 in 1 year. Now, let's say instead of paying it back, they say, actually hold it 1 more year and pay us next year. Now you're accruing 5% interest on $105. So you're actually in 2 years be paying back 5% of $105 plus the $105. So you can start to grow almost exponentially with compound interest. The best example of compound interest is a retirement account. In fact, that's a better example than the loan one I use, because in a retirement account, basically what you're doing is you put in money every month into your retirement account and you never draw it out until you reach the age that you're going to draw it out. So the interest that is accruing on that principal the whole time you have it in that account is also accruing interest. So compound interest is very important to understand for investing. Now let's discuss some of the different loan forms that you'll commonly see when obtaining a loan. Secured loans require an asset's collateral for the loan. This collateral is used as a payment to a lender should the loan be unpaid by the borrower. This usually results in lower interest rates for the borrower. Some common examples of secured loans are mortgages, vehicles, and secured credit cards. Unsecured loans have no collateral, just an agreement to repay the loan. Unsecured loans are issued based on the borrower's creditworthiness. For this reason, unsecured loans may have higher interest rates as well as additional fees. Some examples of unsecured loans are credit cards, student loans, and other personal lines of credit. Commercial loans are financing arrangements between a business and financial institution. Commercial loans are usually used to purchase major capital and cover operational costs. Companies generally provide financial statements to prove their repayment ability. Agri-consumer loans are smaller farm loans directed specifically to farmers and other agriculture expenditures. Agri-consumer loans enable farmers to secure equipment, plant, harvest, marketing, and otherwise diversify their farms or agriculture ventures. Before applying for any loan, carefully evaluate your personal finances. Loan terms are agreed upon by all parties involved before money is advanced. Farm Credit offers an array of loans that support farm, land, and home financing. Farm loans at Farm Credit may be used for equipment, operating and livestock, and farm improvements. Equipment loans offered at Farm Credit may be termed for 5 to 7 years. Equipment loans may be applied to items such as horse trailers, tractors, agriculture use trucks, etc. Livestock loans offered at Farm Credit may be termed up to 4 years depending on the animal. Some cattle and livestock that may be financed include cows, goats, poultry, horses, etc. For borrowers interested in farm improvements, Farm Credit offers the option of a short term, which means up to 7 years, or a long term, which means up to 15-year loan. Farm improvement loans may be used for upgrading buildings and structures intended for agriculture, as well as other maintenance expenses. As a farmer or rancher, whether you are just starting out or you have many years of experience, there are times when you need to borrow money to start, expand, sustain, or make changes to your businesses. Farm Credit offers loans to help build your dream home, growing space, or operational expansion. Land loans at Farm Credit can be categorized by farming and building intent. Borrowers seeking land financing with a farming intent have a term loan option of 1 up to 20 years. Land loans with a building intent share a similar lending total, but with shorter term lengths. Building intent loans may be termed up to 10 years. So for example, if you just buy a tract of land, it is just farmland, we can finance that up to 20 years. But if you're going to put a building on it, say build a poultry house, the term of that loan would be shorter because that house will end up needing repairs, and that is our collateral. So that's kind of the thought process behind that, is anything that can, what we call depreciate, or anything that could need repairs fairly soon, and that is our collateral, would be on a shorter term, so you would repay us faster. Farm Credit understands that the process of purchasing or building a new home can often be overwhelming. Specialists at Farm Credit help buyers to understand the home buying process and offer a wide selection of purchasing options. Farm Credit services purchasing, building, and refinancing homes. Home loans may be financed up to 30 years. We offer a one-time closing for home construction loans, as well as a locked-in interest rate. These features help the borrower save money on closing and some building costs. Loans can be a tricky but very useful tool during your lifetime. The most important things to remember are always make your monthly payment. And as I mentioned earlier, I really recommend setting up auto draft for that. Also, if you're able, make higher payments toward the principal amount to reduce the amount of interest that will accumulate and will reduce the overall cost that you have to pay. So for example, if I owe $100 in total and I make a special principal payment onto it to reduce it to $50, then my interest is only being calculated off of the $50 instead of the $100. So 5% of 50 is much less than 5% of 100 if your interest rate would be 5%. So we really recommend that if you're in the financial position to do so, if you can pay ahead on your loan and you don't have a prepayment penalty to do so, then that will reduce the overall cost of your loan. Now, here are some review questions for the credit and loans presentation. The first is, what are the credit score ranges and what is considered a good credit score? The second is, what is the advantage of making higher monthly payments? The third is, what is the difference between simple and compound interest? And the fourth is, for a savings account, would you want your interest compounded more or less often? Thank you for joining us through this exciting presentation. As you can tell, providing personal finance education for students is important to Farm Credit. Today's presentation is part of an 8-part series, so I encourage you to explore the other topics. To contact us, feel free to visit www.farmcreditofnc.com. Thank you for joining me.